And today we are taking a deep dive into the market action for Thursday, June 25th, 2026. And I just have to say, wow.
An absolute whiplash of a day.
Total intraday whiplash. I mean, U.S. equities got completely rocked before staging this sort of breathless partial recovery.
Right. While crude oil and gold just surged.
Yeah.
And that was mostly off the back of some severe geopolitical escalations and, well, some really sticky inflation data.
Exactly. So here's the roadmap for what you're getting today. We are unpacking the overnight global hawkishness that really set the tone.
Then we'll get into the U.S. trading hour shocks, the hot inflation print and those shipping attacks.
Yeah, and finally we'll cover the wild corporate pricing moves happening in tech right now to offset this massive AI memory shortage.
A lot to cover.
It is. And real quick, just a reminder that this deep dive is strictly for market context and discussion, right? It's not personal investment advice or a recommendation. So let's just jump right in. Session 1, what set the stage before the U.S. session?
Well, to figure that out, we really have to rewind to late Wednesday night. Specifically, right around 9:02 p.m. Eastern Time.
Right, the overnight catalyst.
Exactly. So Bank of Japan board member Tamura delivered this heavily hawkish pivot. He essentially came out and declared that Japan's 2% inflation target has already been met.
Which is huge for them.
Huge. And because of that, he advocated for swift rate hikes. So you have this global backdrop where we've talked about dollar strength as imported inflation.
Right.
Well, Tamura's pivot threatens to totally reverse the yen carry trades. And if that happens, it basically drains global liquidity right out of the system.
Which sets everyone on edge before the sun even comes up here, and then the geopolitical picture starts fracturing.
Yeah, at 4:49 a.m. Eastern Time, news broke that the Lebanon ceasefire had effectively collapsed.
Just totally fell apart.
Yeah, Israel's Prime Minister Netanyahu and Defense Minister Katz completely refused to vacate the southern Lebanon buffer zones.
See, and this is where I kind of have to push back on the market's reaction this morning.
How so?
Well, traders were treating this like it was some unpredictable disaster, right? Like a meteor strike. But if you look at this through a game theoretic lens, isn't this just geopolitical brinkmanship as bargaining leverage?
You mean because of the broader peace talks?
Exactly. I mean, Iran previously tied Israeli withdrawal from Lebanon as an absolute red line for the broader U.S.-Iran peace deal. So neither side can afford to look weak right before they sit down at the table.
That's a fair point. It's high-stakes posturing.
Right.
But the market still has to price in the risk of accidents.
Yeah.
And it wasn't just Lebanon. At 3:21 a.m. ET, we got a report that Iraq is actively threatening to exit OPEC.
Oh, wow. Over the quotas.
Yeah, they're frustrated by the financial crisis that was basically triggered by the whole Iran war.
Yeah.
So Baghdad is throwing this threat out there. And even if they stay in the cartel for now, it introduces this serious medium-term risk of structural oversupply.
Because if they just start pumping oil to fix their budget, the whole pricing floor collapses. Okay, so just to wrap up the early hours going into the U.S. Open, we basically had a hawkish Bank of Japan threatening to drain liquidity and crumbling peace deals across the Middle East.
A very fragile setup.
Extremely fragile. All right, we're going to take a short break, and when we come back, we'll dive into how all that fragility completely shattered once the opening bell rang in New York.
Welcome back. So let's get into session 2. What moved markets during U.S. trading hours?
This is where the tape just got ugly. So at 8:30 a.m. Eastern Time, we got the macro data drop, May core PCE.
The Fed's favorite gauge?
Yep. And it printed at a very elevated 3.4% year over year. Plus, the headline PCE actually reaccelerated to 4.1%.
Which is not what anyone wanted to see.
No. But the crucial part, the part that really spooked equities, was that U.S. consumer spending unexpectedly dropped 0.7% month over month.
Right, which is just textbook inflation as a self-reinforcing spiral.
Exactly.
You have prices continuing to rise, but the consumer's being totally squeezed and pulling back. They're spending less, but everything they buy costs more.
And the Fed basically offered zero comfort. Around 2:04 p.m. ET, we got commentary from Fed officials Goolsbee and Williams.
Oh, they leaned all the way into the hawkishness.
They really did. Williams officially pushed expectations for hitting the 2% target out to 2027 or 2028.
Wow.
And Goolsbee was out there expressing unease that all this AI capex is just overheating the economy, which, enforces that concept we talk about discount rates as financial gravity.
Because if rates stay high until 2028, the present value of all those future corporate earnings just plummets.
Exactly. It's mathematical gravity, and that gravity sent the S&P 500 futures sliding from 7,496 all the way down to 7,390 intraday. Just a brutal flush.
But wait, didn't we have this whole narrative that tail risk removal as a market trigger was going to save us?
Right. The U.S.-Iran Hormuz deal.
Yeah, like the strait reopens, cheap oil floods the market, inflation cools down.
Well, the problem is that neat little narrative is unraveling live.
Right in front of us.
Yeah. The UN Maritime Agency had to pause its ship evacuation plan today because a cargo ship literally got attacked by an unknown projectile in the Gulf of Oman.
You can't evacuate ships if they're under fire.
Exactly. And on top of that, U.S. Secretary of State Rubio spent his entire morning fighting with Iran over shipping tolls. Iran is trying to impose tolls on the world's most critical energy choke point.
Which the U.S. obviously won't accept.
No, Rubio called it completely unacceptable, and the market impact was instant. Crude oil violently reversed. It rallied 4.2% intraday, up to $72.13.
And there goes the energy prices as a consumer tax cut thesis.
Totally invalidated.
Yeah, consumers are just getting hit with another functional tax hike at the pump.
So, to summarize that brutal cocktail, we've got hot inflation, Fed cuts pushed out to 2028, a broken consumer, and rebounding oil prices.
Not a great mix.
Not at all. Let's take another quick break, and then we'll get into the corporate events and see how the tech world is trying to navigate this mess.
All right, we're back.
So, session 3, corporate events recap and what to watch next.
And we really need to talk about this AI capex reality check.
Yes, because late Wednesday, around 4:04 p.m. Eastern Time, Micron delivered this massive earnings beat.
Unbelievable numbers. Their market cap actually blew past Meta and Tesla.
Which is wild for a memory chip company.
It is. But the downstream effects hit the tape today. Apple announced massive price hikes across MacBooks, iPads, and Vision Pros.
Which, if you think about it, is like an analogy of a black hole.
How do you mean?
Like, imagine the AI server build-out is this supermassive black hole. Microsoft, Google, Meta, they are indiscriminately sucking up every single available high-bandwidth memory component on the planet.
Right.
So companies like Apple, who usually dictate terms to their supply chain, suddenly find out there's nothing left. If they want memory chips, they have to pay extortionate premiums.
Apple actually explicitly called it an unprecedented challenge caused by AI data centers. We talk about AI capex as a cycle-agnostic arms race.
Right, they buy chips no matter what the economy is doing.
Exactly.
Yeah.
But it exposes how mega capex as a fragility mask is operating here. The tech sector looks strong on paper because of all that spending, but it's masking deep structural fragility downstream.
Margins are getting squeezed by component shortages, and Apple has to pass that cost onto a consumer that is already tapped out.
It's a tough spot to be in. But on the flip side, the banks are having a great time.
Oh, totally different universe for the banks.
Late Wednesday, 4 p.m. ET, the Fed released the bank stress tests.
And 32 large banks passed easily.
Passed with flying colors.
Yeah.
And instantly, Goldman Sachs and Morgan Stanley announced massive dividend increases and multi-billion-dollar share repurchases.
Neatly sidestepping that whole fear of buyback bans as an EPS headwind.
Exactly. Regulators gave them the green light and they turned the spigot right back on, which honestly leads me to our closing bell joke for the day.
Let's hear it. So, average investors are likely feeling pretty whiplashed and defensive today. If you survived today's tape without needing a stress test yourself, you did better than the big banks. We've got the Fed pushing our 2% inflation dreams out to 2028, while Apple is raising prices so fast you'll need a personal loan just to buy a new MacBook.
Oh, man.
On the bright side, if you invested in Micron, your portfolio is officially doing better than Meta and Tesla combined today. For the rest of us, between the actual earthquakes in Venezuela and the geopolitical ones in the Strait of Hormuz, I'm starting to think the best inflation hedge is a bunker. Have a great evening, try not to check your 401k, and we'll see you tomorrow for whatever crisis is next.
I love that. But before we hit the bunkers, here's what you actually need to watch next.
Right, the calendar.
Yeah. So Thursday at 6:30 p.m. Eastern Time, Chicago Fed President Austin Goolsbee speaks.
Keep an ear out for more AI overheating talk there.
Exactly. Then Friday at 8:30 a.m. Eastern Time, we get the May wholesale inventories. And crucially, Friday at 10 a.m. Eastern Time is the June University of Michigan Consumer Sentiment Index.
That sentiment reading is going to be critical given how squeezed the consumer is right now.
Absolutely.
Okay.